to be here. Thank you again for inviting me and for the opportunity of presenting more about my passion personally, working with early stage startups and in emerging countries. I'm originally from Congo, grew up in France, and I've been dedicating my career in understanding how we can link the European and the African continent and support more early stage startups to get access to funding. So today we'll focus more on the perspective of impact investors, because I've identified in the past and with the Melanin Capital team that those are investors that are really suitable for early stage startups in emerging countries, and we'll discover together why. But first, maybe just a few words about myself. So I'm Mélanie. I've worked mostly in impact investment funds that are focused on the African region, started with INVESTI Partenaires in Francophone Africa, and now in Frankfurt at Finance in Motion. I also have more of a development perspective, as I worked at the United Nations in 2018, focused in Kenya and finding, let's say, funding opportunities for local governments to invest in infrastructure. So now I have two hats. I'm working as an impact investor, so really in the inside of the mind of those impact investors, looking at deploying capital in emerging markets, namely in Latin America, Middle East, and Africa. And I also have my second hat as the CEO of Melanin Capital, where we support mostly young early stage founders to get access to funding. And just a few words about what we do at Melanin Capital. We basically work in collaborations with amazing institutions like Bridge for Billions, who already support all the way the early stage entrepreneurs. And then what we do is to advise on the extra mile and finding funding opportunities through investors and business partners in Europe or in the US. So we are very happy again and delighted to be here and to explain a little bit more how we advise our entrepreneurs and how we support them to get access to funding. So today, basically, what we'll focus on is to understand first the market of impact investors. Who are those investors? How do they work? What are the different concepts around it? And then we'll deep dive into mostly the processes and the strategies, so that you can really understand as an entrepreneur how they perceive an investment when they talk to entrepreneurs like yourself, and how they do the assessments. And at the end, we'll discuss a little bit more how you can get access to this type of funding, and what are the main areas that you have to pay attention to before in preparing your fundraising, basically. But let's start with the first section. And as Alex has mentioned, this is an interactive session. So as much as possible, please share your comments, share your questions, and we'll have a little bit of time at the end, at least 15 minutes to discuss a little bit and answer your doubts or your fears, anything that you have in mind. But first, let me explain to you just a little bit why I wanted to focus on the impact investment side of things for early stage startups. What we realize in our course of activities is, and me also as an impact investor in larger funds, is that for startups in emerging countries, you have this ambition to grow, and this is really something that you would like through a larger teams with a larger range of products, but all of this require investments, at least, or financing to start off and cope with the lack of revenues that you unfortunately can't have at the start. And it is very difficult to actually get access to that funding, and specifically in emerging countries, because when investors look at opportunities in general, they have first this balance of risk and reward, and emerging countries are mostly seeing and considered more risky, so they either ask for a higher return or they simply don't engage in those countries, which is usually a big issue. Like I worked with a lot of and discussed with a lot of entrepreneurs in Sudan, for instance, and definitely in those countries there were very few investors that would dare try to deploy capital in this region, in this country specifically. So then you have a complete gap of not having access to funding. And then the second problem next to the risk is the traction. Those investors are usually looking at companies that want a certain type of revenues that have already been reached before they provide any equity or debt funding. And unfortunately, it's difficult to have that kind of traction if you don't have that funding. You're actually raising funding so that you can increase your revenues. So it's a little bit of a conundrum that is really pressing and challenging entrepreneurs. And we found that in impact investing, there is actually a range of new type of investors or different types of investors that are engaging that can actually cover the needs that you have and be adapted to the local environments that you are operating in. But just a little bit, if we go back in history, actually, yes. Model to address the world. Yes, sorry, there's a, I don't know if you can hear the sound. Can you hear? Okay, that's a little bit of an issue.
Yes, when you put it on, we can hear.
Okay. Interesting. Then maybe we'll just hear the video, because I had a few comments that I wanted to put on that video on mute, but that's okay. Then we can hear. I just wanted for you to have a little bit of historic on impact investing and understand where the concept is coming from, given that this is a concept that is actually not completely new. It started already in 2008 when the crisis in the US started, and we had all these troubles thinking about finance and sustainable development. But let's hear a little bit about it so that we're all coming with the same background on impact investing.
Most urgent social challenges. On the one hand, we make a living. On the other hand, we give back by paying taxes and donating to charity. But despite the tireless goodwill of philanthropy and government, many economists agree that the combined efforts of these sectors are no match for the magnitude of the world's social problems. Many economists also agree that tapping the power of the private sector has the potential to narrow the gap. This new wave is attracting an increasing number of investors. The movement has been dubbed impact investing. Impact investing is innovative, it's disruptive, and it's a $77 billion global industry. As an emerging model, there's still much debate surrounding the variations and even the definition of impact investing. But for the purpose of this introduction, we'll simply examine how impact investing blurs the line between traditional giving and traditional investing. On one side of the spectrum, you have dropping money into a donation bucket. You hope that it will make a difference, but you know that you won't be seeing it again. On the other side of the spectrum, you have investing in, say, the S&P 500. You hope this investment will bring a financial return, but you don't know its environmental or social ramifications. Impact investing marries the best of these two approaches by combining the rigorous analytics of financial investing and the heart of philanthropy. Ultimately, impact investors seek a double bottom line return, both a financial and a social return. So, who is an impact investor? She's a venture capitalist purchasing stock in a clean technology company. He's an experienced investor buying a bond to build infrastructure that reduces water pollution. It's a large bank backing an evidence-based early education program. And there are millennials financing a Kickstarter campaign for their first fair trade apparel factory in Africa.
So what you understand here is that we have a whole new movement in the investment world that is kind of trying to change the paradigm between just seeking more profit and more returns, but also kind of having a positive social impact. And this is why this is a great opportunity for a lot of early stage founders in emerging countries that per se actually are usually solving a critical problem in the countries where they're operating in, being in education, being in sustainable energy, in urban infrastructure. We've seen a lot of amazing business model in healthcare or in digitizing education programs during COVID. And this is typically what the impact investors are looking at. And basically what they focus on is being intentionally, to have an intention to create a positive social impact. They will look for return, but this return will have different type of expectations according to the instruments and the funding that they will provide to you. And then they will measure that kind of impact. So this is something that they will embed in the investments. And this is key for entrepreneurs, because then when an investor will come to you, an impact investor will come to you to make your investment, they will privilege the social impact that you're creating and the revenues that you are generating. So it is not anymore just about making the most profit and showing them about the numbers. It is also about telling them how you are impacting the communities. Are you supporting employment for women, for instance? Are you educating a certain type of the population that has been excluded before? All of those factors are factors that are interesting for those impact investors, and I will go into details a little bit later in the presentation. So basically here, if you kind of, before you would only have access to kind of the traditional investors that would look at traditional businesses that just create money, the banks, the oil companies, the mining factories. But there, with impact investing, you have actually those investors are maybe less interesting for you, but you have the whole spectrum from NGOs and charities to those impact first investors that will allow, that will combine philanthropy and investment. And this is something that we'll dig into, is the type of funding that those different investors are providing can help you to actually get to the next level that you need without, for instance, having to get to a certain size before applying for funding. Remember when we discussed at the very beginning, we're discussing about the risk that the emerging countries are representing for the investors and the returns that they're actually expecting from your revenue generation. But here, if you can go to directly a charity or an NGO, then you would not necessarily need to have that kind of revenues, because they would provide some grants and instruments that per se are accepting to not get a return at all. And we'll discuss that in the structuration of the investment a bit later. So just for your information, the type of the main impact sectors that we see and that we think is an opportunity for entrepreneurs in emerging countries that are trying to develop their business are quite large, to be honest, from supporting the youth and small children to also providing financial services to underserved community through microfinance, for instance, or supporting healthcare and sustainable agriculture. Those are the different topics that mostly are responding also to the SDGs, which is always the Sustainable Development Goal of the United Nations, is always a good framework for you to rely on to kind of fall into the themes of those impact investors. So as I was saying, you have a wide range of investors from impact only to impact first investors. And if we zoom in on the impact only, we just fall into the usual NGOs and foundations that we know that can actually provide financing to those entrepreneurs. We see a lot, of course, the main ones also with the Melinda and Belinda Gates, the Gates Foundation, sorry, but they also they don't necessarily give only grants now and also providing equity. So you have to also kind of dig deeper into their operations. But those philanthropic investors would usually work on just projects in the past, but now they are supporting also for-profit companies and private companies to help them to get to the next level. And this is very useful when you are just starting and you need to finance your workforce or the development of a new product, to get access to those philanthropic grants from either NGOs, foundations, and even the states when it's available. And then you have, of course, those that will expect a return and will not only give you money for impact, but will kind of expect you to grow exponentially, or then to give them some interest payments periodically. And here I gave you a few examples of those investors that are operating in either Africa, Middle East, or Latin America, and are very active in the sector. And for those investors, we'll see a little bit later, but they have a different way of working that the normal investors that will just provide equity or just provide loans. They will also provide free advice and free grant funding that we'll discuss a little bit later in the structuration. So who are actually the impact investors? There are now a lot more to engage in those in these markets, and of course focusing on different geographies. But you have, for example, the Action and Acumen that operate in the US and very active in all the emerging countries in Asia, Middle East, Africa, and Latin America. We also have the development finance institutions, which are state-owned institutions like the French Development Bank or the German Development Bank, but they're focusing on, I would say, a little bit a later stage in the early stage segment, let's say. But then if you really want to start grassroots, the NGOs and foundations are becoming really active in providing the subsidies and the grants that you need to start comfortably your business. So now we are already trying to understand in the second section, why would those investors do impact investing? So why would they agree to come in a geography that would be more risky, or to accept to have lower return? And how do they work with social businesses and social enterprises? I think it is very important for entrepreneurs, and we try to always kind of get back to the investors when we advise our entrepreneurs at Melanin Capital, because if you understand your main client, which is here the investor in your fundraising phase, then it is always easier to present to that investor exactly what they expect, and to phrase your project in a way that it is more likely that they will get access to funding. This is a bit of a complex concept, but that's something that has been developed for let's say the past 10 years, which is called blended finance. And this is how most of those impact investors are structuring their activities to be able to do impact investing. They have the private capital that they can raise themselves from high net worth individual or other investors that are larger and are looking for a profit. And they have on the other side this development funding coming from the States or coming from other bigger NGOs that are trying to still make a profit, maybe very low, but at least make a little bit of revenues in emerging countries while having a positive social impact. And this is key for you to understand that they have those two kind of pockets, because this is how they will use that type of funding to then support you in another way. And this funding obviously have different expectations. For the private capital, they will come there in those type of funds because they have, for example, a corporate social responsibility strategy where they want to show that they are sustainable and they are doing positive impact in emerging countries. While for development funding, the NGOs and the governments, this is part of their own activities and their own business. So they are both coming kind of supporting entrepreneurs like you. They have this expectation. So, but they also have expectations of getting a return out of this investment. So then from this structure, the investors actually have a larger possibility of spending this funding through the entrepreneurs, and they do it through three means in general. So they have the classical equity or loan investments. So they're either taking a share of your company, or they will provide you a loan that you'll have to repay periodically. And this is it can be 30, 40, or 50% of the funding that they give you. And the other type of funding, because you are in the early stage phase and because they want to support your growth, they can come with a grant funding, which then has no return expectation. They will not expect you to give it back, or they will not expect you to grow exponentially to be able to provide results. So that's a very key instrument that the impact funds that I showed you, Investisseurs et Partenaires, Finance in Motion, Acumen, Action, then are using on early stage entrepreneurs. And for you, this is a big added value, because the pressure that an equity investment or loan investment can put on early stage startups can actually be quite unhealthy, because you will look at maybe diverge your mission to be able to meet those revenue requirements, or you can maybe lay off some salaries or optimize your cost to be able to have a higher net profit in just to satisfy those equity or loan investments. But with this kind of structure, at least you have some room to breathe and to take more time to structure your operations and grow without already generating a profit. So we think this is very positive. And the last part that they also coming is what they also call technical assistance. And this is capacity building that is actually provided for free. So they analyze basically the areas where you have some needs. If it is, for instance, to reinforce your financial capacity, or to implement a new marketing strategy or a new commercial strategy, then they can come with a consultant and support you to implement those framework with the best practices in mind. And this is something that you benefit for free, and that adds a lot of value in your business. This is basically like just an example of Investisseurs et Partenaires, which is very active on the African continent, and that's exactly what they provide. And that's what I've seen in working with them, that worked a lot with the social entrepreneurs in Africa, because then they will come with most of the time an equity or loan investment that of course provides enough funding for the entrepreneur to grow, to invest in new machineries or invest in a new workforce, etc. But also they help them all along the way through technical assistance and mentoring so that they can reinforce the organization. And of course, indirectly, they will benefit from it because the more you grow, the better the returns for them. But for you, this is definitely tremendous value that is brought to your business. And this is also why we think that those are the investors you should target primarily, because they will bring you more than just a commercial investor. But just to keep in mind, so what are the key characteristics that they want to provide to the investor and that they will make sure that they achieve through an investment with you is their investment has to contribute to the sustainable development goals of the UN. So they have to provide a positive social impact. And this is why when you discuss with impact investors, and I will repeat this throughout the presentation, but designing your impact strategy, how you are supporting local communities, what kind of positive impact you're creating or negative impact that you're saving, such as, for instance, the development of CO2 emissions. If you are recycling or if you are implementing renewable energies, then you're saving on negative impacts. This is very important that you design it in a comprehensive way so that this becomes attractive for those impact investors. Again, they expect most of the time, except if they are just grant funders, but they expect a positive financial return, which means that you will have to showcase the market potential and how you'll be able to grow. And for them, they are working with public and private parties. It has to be something that can support the private capital that they have in the funds. And of course, we cannot not talk about the numbers and why this is an opportunity for you. There are more and more impact investors at the moment, given the challenges of climate change and the rising inequalities that we are observing across the world, and the different consequences that come out of it, such as the social unrest or the migrations. So they're basically more and more investors that are engaging in this market, and this is an opportunity for you because this will mean that there will be more and more capital available for you to raise from. Now, how do they work and how can we get access to that funding? This is really an important part of what I wanted to share with you today, is how you make sure when you discuss with those investors, you actually transform this discussion on a funding opportunity. And for this, we need to understand fully their processes and their mechanisms. So an impact investor has the investment strategy that we discussed about, like the different themes that they're covering, the different geographies, and how they want to work with entrepreneurs, be it through grants, equity, etc. This investment strategy is usually public, and it's not difficult to find on the internet. And with this, you can understand whether you fall into those into their criteria or not. From there, those impact investors, they will actually look for opportunities. This is their bread and butter. Then if they don't invest, they actually don't make money. So they will be forced to look into the internet, going to on the ground to meet actually you guys and see if they can partner with you and invest in your venture to grow with you and generate income with you. Once they have identified that they can be a suitable partner for your business, they will go under a due diligence. And this is in the next section what we'll really work on together, because this due diligence phase is actually something that most entrepreneurs are failing, unfortunately, just by not understanding the key requirements of those investors. And some things are, when you have a checklist as an investor, is if you're not ticking it, it's not even you that will not decide to invest, but it's the different committees that an investor has that then will have to discard your business, even though this is a great venture that is making a lot of impact. If they don't meet their requirements, they won't be able to go ahead. Then something that is also very important is how do you structure the investment? How do you make sure that you get the most out of this investment? Usually, and this I understand it very well because I also have a company of my own, and I sometimes when you want funding and you want money, you can be a little bit blinded, but actually structuring the investment and making sure that the terms or the type of funding you're getting is optimal is very important. And you have to make sure that the investor is not optimizing on his side the return, but more optimizing what you need to grow. And finally, of course, once they have invested, they will monitor your performance, and they will try to see if you're growing, if you're performing properly, and then they will support you wherever possible if they see that you have some needs or some weaknesses in your business area. So as I explained, it can be your financial management, it can be it can be your marketing strategy, it can be even a new technology that you need to implement if you want to digitize your processes, it can be recruiting a new CEO. It is quite of a large areas of services that they can provide and that you should request for to benefit from. And the exit is where they get their money back and how they basically get the revenues. And this will not cover it, but because we are in the fundraising process, but this is helpful to understand on your side how they're working. And obviously for them, everything is about also the exit, because this is where they will make the return. So when we work on the deal structuring, and unfortunately I'm not a lawyer, but what my advice would be, make sure you have a good lawyer, because that's basically where they will try to cover their backs and protect themselves. But this could put you in a difficult situation if you don't have the right protections in place. So let's dive into it in the next. We still have 15 minutes to discuss the last section, which is the more practical one. Is how do we get access to these funds, and how do we make sure that we cover all those steps that we discussed before. Keep in mind those steps, because we'll try to think about how we can fill them in the best way. So as the investor, we start by screening the market and try to find what kind of companies are suitable for them. Make sure you are visible. Make sure you get into their radar. I'll give you a concrete example. So at Finance in Motion, I look into financial services startups, any company that provides a financial service to micro, small, and medium enterprises. So of course, my daily work is to actually go on Google and to check what are the startups in the fintech area, in the insurtech area, even in the agri-tech, as long as they provide a financial service. We'll go to conferences, we'll go to different pitch events just to meet those entrepreneurs and see which one can fit into our revenue requirements, our impact requirements, etc. So make sure that you meet an investor like me when into your journey. Like, make sure you network with different impact investors when you see conferences or workshops like the one for Bridge for Billions that are inviting an impact investor. Make sure that you are visible and that you ask questions and that you can connect with them on LinkedIn later. You can also, as an entrepreneur, of course, the more you speak on pitch events or in conference, this is definitely something that will make you visible and will kind of build traction around what you're doing. So this is an innovative way of also trying to be visible towards those investors. Another thing that not all founders think about is to leverage on their business partners, and this is why we are working a lot with also corporates and other larger companies to support the entrepreneurs that are in our network. Because if you manage to have a larger partner that is working with you and kind of bringing you some business, this helps the investor to also be reassured, first of all, to see that you are backed by a large company. So for example, if you are in a fintech world in Africa and you're working with EcoBank, then this brings you a lot of value out of a sudden, and this can help you to, one, be more credible in front of investors, but also to get access to the partners of EcoBank. And EcoBank has a lot of different investors, so this is a way for you to meet other potential impact investors and talk about your business and your projects. And even if they're not coming at that stage, at least they'll have you in mind later. And then also besides the business plan competition that we discussed about and where you can attend, you can also make sure that you have in mind specific investors that you would target. Sometimes we think that investors are kind of coming to us, or that they have like this top-down approach, but actually it is very important that you understand really well which investor would be suitable for your business, because not all company or person with money is actually someone that you would like to have on board on your business. Can this investor actually provide technical assistance or free capacity building? Is this investor actually expert in your sector and in your country? Because that can make it very difficult when an investor is, and we see this a lot in early stage startups, when you have angel investors that are quite impact oriented but don't understand really well the country, and then we try to kind of re-engineer what you've done but in a way that is not adapted. So make sure that you've targeted in a desk research the right investors for you, the same way that an investor will target you through that same research. As we say, they will always see emerging startups in emerging market as more risky. So be very aware of the risk that you are coming with. Let's say we usually, I mean, there is not a clear framework on the way that investors are assessing risk, but the easiest one is the PESTLE framework, where you assess the different factors on a political, economic, social, technological, legal, and environmental side. And if you already know what type of risk you are exposed to in your environment, then it is always easier for you to target and discuss with the right investors and make sure that you can answer the doubts and fears on your own operating environment. Well, then, I will give the PowerPoint to Alex so that she can also give it. I put a lot of different concepts, but I think it's important because we don't always have in mind how we can frame the different requirements of an investor's due diligence. And as I told you, for an impact investor, they will focus on two aspects: the social impact aspect and then the financial impact aspect. So it is important that you have already structured not only a commercial strategy, but also an impact strategy. And one of the framework that you can use, which is widely used in the sector, is the theory of change that we'll see a little bit later. And basically to just frame what are the different inputs that you have, what kind of impact this will create, or what kind of output. We go into detail in the last slide, but I just wanted you to have this in mind. And aside from the theory of change and the impact strategy, make sure that you can actually measure your impact, because this would be an additional argument and an additional way for you to market yourself. You know, usually you would go to an investor and say, I'm making 1 million revenue a year. Well, he will totally understand that directly. But if you can also explain, like, I am creating 10 new 10 new job a month, or I'm supporting 1,500 children to get access to cheap education. These also are clear key performance indicators that impact investors would also be very interested in, even more than on the revenues that you usually would market. And then on the financial and the operational sustainability, of course, those are very key, let's say, very key information that the investor will focus on. And for this, there's a very, let's say, standardized way of looking at your company. They will, of course, look at the market that you address and see if there is any potential for you to grow or to increase your revenues to get more traction. And they will look at the different financials. So there we also saw that there was a huge issue in the early stage market, because you don't necessarily have a lot of financials behind you, especially if you started this year or like even a few months ago. Then I mean, you won't have a big history. So this would be difficult for you to showcase. What you need to showcase at least is the potential. How many clients do you think you can have, and in a realistic way? Would you have, for instance, we worked with one of our startups in education in Southern Africa. They were just starting and they were raising funding, and we're telling them, okay, who are your clients? They had one large school as a client. This is a good start. Do you think you can work with the other schools? Yes, we can. How can you? If we have a partnership with the state, with the Ministry of Education. So we push them to at least have a letter of engagement from the Ministry of Education of their country, so that they could showcase that they could work with other schools in the country sponsored by the state. And then for the investor, then this becomes an actual and concrete possibility of future income, and then they are a little bit more comfortable engaging with you. But sometimes we think that because we have nice figures on Excel, this is sufficient, but it's not. You have to actually provide them proofs or concrete steps that you will achieve to get that kind of income. And then in the operation and organizational resilience, this is big words to say that they want to see structure, and this is something that I know is very difficult when we start a business, because we don't have time. We don't want to work on policies or strategic plan or the different paperwork that are not actually bringing value to us. It is just being stored here, and it looks well organized, but it's actually not bringing value to the business. At least that's what we think. But when the investor says, oh, I'm very interested in your business, I think there is a huge potential, let's go on a due diligence, and then you have nothing. You have to go and scan everything, and you have to spend a month to just gather all the administrative paperwork to show to this investor. This doesn't look good. And we had the case where we had to wait for a month and 2 months, and then the documents are missing, or they're not really really well, let's say they're conflicting between each other, or they're not really well completed. This actually gives a bad signal. So I would say, as you go along, this is always easier to do it day by day. So as you go along, make sure that your operations and your organization is clear and documented, so that you can easily share it with investors that are interested. So we usually give a checklist that then the entrepreneur can put in what we call a data room, and then when the investor starts with the due diligence, when they say they go ahead, we just sign a non-disclosure agreement, and they open this data room, and they can get access to your impact measurement policy or your strategy of impact. They can look at your financial models and the different financial statements that maybe you have in the past. They can look at your pitch. They can look at your marketing strategies, your different monitoring tool that you've implemented, and of course the contract, even the contract between your interns, between your partners, your clients. They will want to see everything that you're doing in the course of your business. So those are the key documents that I would say would be good for you to have stored in a cloud, and at any time you can just send the link, and you're free, and your mind is in peace with that. So I was promising you that we'll talk a little bit more about this theory of change. We'll do it very quickly, but this is just a framework that has been mostly used in the development industry to kind of frame which target group you are focusing on, what are the different activities that you want to carry out to support these target groups, and which are the outputs that you think, so the different products or services that you will provide, and then you can then measure the different outcomes and frame it to an impact. Of course, there's small steps, intermediary steps that you can take and provide more details. The more the better, but I think this is a good way to look at your impact activity and to frame it to an investor, so that he understands that you are targeting a tangible impact in your community. And now that we've discussed the deal screening, how you make sure that you're being visible, then how do you respond to all the the due diligence requirements, we can discuss a little bit more about the deal structuring. So what do you ask for? Because the investors will come with a bunch of different instruments, different type of loans, different types of capital, and for this you have to understand which one is the more interesting. They all come basically with return requirements, and this is what you have to make sure you understand really well, is what is expected from you. We've seen a lot of entrepreneurs going for even an equity investment, but then they have to give up 40% of the capital, or a loan, but they will have then to pay back in the next year or two the entirety of the loan with plus interest, and this will really impact the operations. You have to make sure that before you getting in bed with an investor, you understand what he expects from you. And what we like in the impact investment market is that they most of the time will come with grants, so cash directly, that will not have any expectations, and that can give you free kind of a breathing time for you to structure it and to support it. And you see, like in your stage of your company, when you start at the very beginning, just experimenting your product, this is where donations are actually very, very important. Equity, of course, is always good, because fine, you provide, you give up a share of your capital, but you still have 5, 6 to 10 years before you give back that money. But I want to manage expectations here. Investors providing equity to early stage startups, very early stage startups, are very rare. So they usually have ticket sizes. So they usually invest $1 million and above. So then you have a whole bunch of entrepreneurs that are left out just because of this one requirement. So that's why we are sometimes directing our entrepreneurs towards NGOs and foundations that then would be more interested in supporting smaller sizes and maybe get lower returns before you go for the big investors. And I've already talked a lot, so let's conclude before and have some possible to have some questions. Basically, just to summarize and why we think that impact investing could be very adapted for early stage entrepreneurs in Africa is because they have a more balanced risk reward strategy and they are more patient before you get traction. But we advise you to always make sure that you choose your investors properly and you make sure you're visible to the investors that you would like to privilege, because they will provide you additional value through technical assistance, capacity building, and they will wait for you to grow before they ask you any hard return expectations. And then, of course, we always advise for you to show your traction and make sure you are as structured as possible so that you can keep and retain those investors that you have identified. Thank you very much, and sorry for being a little bit late on the time, but I hope we have still at least 10 minutes to discuss for some questions.
Thank you so much, Melanie. Sorry, we have quite a few questions. We have at least 7 questions in the chat. I can read it to you if you'd like. And you have some applauses, so this means that people find it quite interesting. I personally thought it was quite insightful and full of references, so thank you for that. Maybe I can read them through to you, and you guys, if you put the question and you want to add anything, feel free. Let's just try to maybe be brief so we can count with everyone's question and cover it. So Nicholas is asking, does it make sense to already ask for money before you have an MVP? Rather wait until MVP is ready or ask money after launch?
Okay, does it make sense to, okay.
It's about, is it too early? When is it okay? When is it not?
Well, I would say it's before having an MVP, it's tough because you will spend then a lot of energy trying to discuss with investors without having an actual proof of existence. So we've actually tried with a couple of entrepreneurs, but then the investors, you see, for themselves, even if they were convinced, they have to convince their committees when they are found. When the angel investor is a little bit different, and I think this is why also in the US we see a lot more startups being funded, because you have much more angel investors, and then it's just a matter of convincing him or not. If he thinks that you can go on the moon with your project, then he's alone and it's his own money. So then he can go for it and you can try it out. In our markets, I have to say, it's a little bit rare to see especially like where I work, especially in Congo or Kenya, Senegal. It's rare that you have someone that just says, you have an amazing idea, let me just give you $1 million to achieve it. So we usually advise to work on the MVP, there is nothing better than actions to actually show what you're capable of. So show that there is at least clients for what you're proposing. They're ready to pay for what you're proposing. And then even if it's just a couple of €1,000, maybe you need an additional technology, maybe you need more workforce, and this requires investment. But at least you can showcase that you have you have a potential, a growth potential. Then if you really need, for example, you need to build a robot or something very high tech, and you really need investment before that, this is another story. And you need to make sure that you are talking also to the right investors for that, for high tech investors that really understand that sector, or for investors that are very specific to that project. So if you want to build a space project in Africa, I would not go just to African investors. I would go to specific space investors that understand that you need an investment before even having an MVP. But those are very specific cases.
That's great advice, Mélanie. Then I would move to Tati's question that says, what could be possible challenges for startups when being funded by impact investors? And are there also difficulties or flip sides when being funded by an impact investor? This is quite interesting.
Yeah, it is. This is where we stop being marketing and we actually give the truth. I would say what is very important is to understand that impact is not an exact science. So at the moment, there are still investors that are searching themselves, I would say, in terms of impact. And that's why I was telling you, make sure you target your investor well, because it's not because this investor has a fund, a lot of money, that they actually know that's what they're doing, to be honest. So you have to make sure, look at the other portfolio companies that they have, and if you have even the possibility, talk to them, because I've seen in the market, for instance, impact investors, especially those that are coming from Western and wealthy countries, with Western and wealthy concept of development and of what is impact. Then we come to an enterprise, change everything, and the enterprise at the end is actually less profitable than it was before, and it can be in deep problems. I give you a concrete example. In Western and Central Africa, economies are mostly informal. So if you look at a country like Benin, for instance, 70% of the economy is informal. So like employees don't have a formal contract. They don't pay taxes. And I've seen investors coming into very profitable companies that provide a very needed service, but all their workforce don't have contracts. So the first thing they would do is to make sure that everyone has a contract, everyone is paying the taxes. So then usually 50% of the employees resign, and then you have also a bad reputation. It's very difficult to employ new recruits, and you come from a company that was that was very profitable to a company that is actually struggling. I'm not saying that we should always leave the company as it is, but you have to respect a certain process, and you have to understand the local environment and make sure that you are not completely disturbing an organ and a machine that is already working well, because it's working well for this environment. So I would say the challenges of impact investors sometimes is the impact or the idea of impact, and you have to make sure that you are like-minded when it comes to creating positive impact in the countries.
Thank you. So now Nicholas, actually, sorry, another question. So does it make sense to mix equity and impact investor? I think there are two concepts here. In other words, having both types of investors investing in your business.
Yeah, it's a very good question. It's really a strategy on your side. To be honest, equity investors, so let's say commercial investors, those that would look at only profit. It happens that you will have to mix both, and then you have to see which investors is bringing value to you. Like maybe the commercial investors can bring you more value in optimizing your business and in making it more profitable, and then the impact side more on finding the right impact strategy and kind of create more impact. I think it does make sense. You just have to make sure that those two investors are not clashing in terms of vision, because this could become quite messy. But it depends also on your size, because when we look at larger companies, if you have an impact investor that comes because this is Latin America, for instance, and they want to have an impact in Latin America, and they are alongside private investors, local private investors. If you're a big company and in any case you're already making profits and you don't, I don't think you will really clash, then the impact investor would only be a plus. I always think that the issue of having just commercial investors is the return requirements that they would put on your shoulders. That's why I usually not advise to have them at the very beginning, but I think it's possible to have a mix, to be honest. I don't think it's exclusive, mutually exclusive.
And sorry, Nikos, because I feel bad. I'm just reading your questions and you're there, but I'm going to read the other question you put. I'm working on a digital platform applicable for various countries and languages. Does the geographical aspect of finding an investor make sense here, or can it be neglected? This is quite interesting.
So is it meant on the
sector, I believe, or the innovation that is applied here, the fact that it's a digital platform? Would you like to comment, Nikos?
Yeah, sure. Hi. So yeah, just to explain, yeah, it's basically a social language platform. It's basically, well, if you want to put it as in simpler terms, like basically a Duolingo or Bubble 2.0. Yeah, in this case, I'm just wondering if, well, the ultimate goal is to provide various languages. Mm-hmm. And then does the geographical aspect of an investor really matter or not?
Depends. I would say, for example, out of my mind, because again, I'm very biased when it comes to impact investing. I'm always looking at Africa, but if you're providing different languages and specific dialects in Africa and helping, for example, a person like me to learn the tribe language, I would say that definitely matters, because if you are focused on a specific region, that would be a plus for you to actually provide to investors. And then your social impact would really be to be able to maintain a certain language and make sure that this is educated for all the populations and the diaspora. So then the social story is really linked to the geographies. But if you are providing all the languages in all geographies, then I would say what would make more sense is to focus on the education sector based investors, and then the investors in your country. I don't know where you're based, but then the investors that would be able to invest in your country are the ones that have a mandate for your region. So for instance, a fund that would only invest in Africa would not look at something that is based and registered in Asia. So you have to make sure that you also target the investors that have a mandate of the country where you have registered. But if you registered in Asia, for instance, but providing languages in Africa, then you have the double card, I would say.
Okay, thank you so much.
No problem.
Thank you. Then from Andreina, what are some differences between angel investors in emerging countries versus other countries with more stabilized economy and ecosystems?
Yeah, it's a very good question. I would say, more stabilized economies, they're easier to find than in emerging countries. And now it's growing more and more. I would say 5-6 years ago, those angel investors would be completely hidden. But I think honestly the way that they invest, when I look at the angel investors in Africa, I really find it fascinating because they really function a lot like Americans somehow. They're very quick in their decision making. They're very flexible. They're very hands-on, very on the ground, and that's really awesome because this is exactly what an entrepreneur needs, right? So they need an investor that is able to be alongside them and give them advice and also like find them the right connections and everything. And I would say that even in emerging countries, this is something that we still see. Really the problem is the availability of those investors and the number of those investors, I would say. Because then I wouldn't say they're more shy or they're more risk averse. Like honestly, they understand really well their market. They will not, you won't see a Southern African investor go to Egypt or go to Brazil. If they don't understand the market, they won't do it. But when they really understand their country, the sector, they'll just go for it. No problem.
Okay, we have couple more. So we have Hannah just asking if there's a standardized approach to measuring SDGs. Would you like to just share about the
about the approach? No, that's very disappointing in impact investment in general, I would say. But there's no, there's not a very clear approach on that. I mean, there are more and more companies that are trying to standardize and even there's a company based in Frankfurt and I saw that Maxime was here, but Roots Impact Capital is actually a company that can provide investors with standardized approach to kind of measure the impacts through the financing, through evidence and everything. So that's very good. But in the sector, I wouldn't say that this is something that is that SDGs are not widely measured.
Thank you. Actually, this was the last question we had.
Okay.
Yes, I think so. Then Anna also shared a little bit on the SDGs, so thank you, Anna, for that. And I think, and Lena also shared now, so thank you for that. Yes, I think that would be it in terms of questions. Melanie, do you have any final comments just before we close?
No, not really. I would like to thank you very much, everyone, and thank you for your amazing questions. That was so nice to connect and to discuss more about that. I really enjoyed it, and I hope this was helpful. If you have any other questions, you can let Alex know. I will be very happy to also support via email. Of course, I've just shared our email, hello@melaninkapital.com. We're also very happy to answer any inquiries if you need any advice or anything else.
Thank you so much. Thank you, Melanie. I thought it was a great session, like very, very on the ground, you know, like I really loved it. It was very resourceful. For everyone here, we will send a recording. As I was saying, we can send Melanie's presentation when she sends it over to us. And there's, just letting you know, there's another session coming up next week. It will be around the pitch deck. So you can really ask the questions and challenge if you're getting the right format. What does it mean? What does it mean that each thing that you should include your pitch deck and why? And also a little bit of how you can manage expectations while building up that storyline, which is a storyline even after all. So do come, use it as a workshop opportunity, share this with other founders. And yeah, you know my email by now. I will share Melanie's contact here too, so you can research about her work and what Melanin Capital is doing. And yes, thank you so much for joining today. Hope you have a rest good of the day, everyone.
Thank you. Have a beautiful day, everyone. Thanks a lot again.